It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco. Good morning and good evening. It's 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world. My name is Patrick L. Young. The IPO-VID Livestream Series 2 starts here. We left Series 1 after 6 excellent shows and Golfgate removing the Irish Commissioner for EU Trade, Phil Hogan. Now quarter 4 beckons and it's all to play for. Macroeconomics have rarely looked so exciting while geopolitics are bubbling along with all manner of potential high-volatility interjections for investments in every asset class. And that's before we get anywhere near incendiary issues such as Brexit. With the European Union unable to negotiate a coherent free trade agreement, at present at least. This, of course, may change. It's one of those things. Brussels seems to always like to agree things just well on the stroke of midnight. They have a tedious 11th hour fetish, albeit we're around 22:58 right now. The UK government is moving ahead to clarify the Northern Ireland Republic of Ireland border issues without defenestrating the United Kingdom of Great Britain and Northern Ireland in a practical fashion. Cue meltdown as it becomes real to its opponents that Brexit is indeed real. Elsewhere, the UK government have announced a new Board of Trade, not a futures trading venue, I hasten to add, but a group defining the future for Britain, including various excellent minds on trade, such as the UK-born former Australian Prime Minister Tony Abbott and the former Conservative MEP Daniel Hannan. And almost entirely ignored in the legacy media, ladies and gentlemen, but of course a fascination to financial folk like us. The UK have announced a fantastic free trade deal with Japan, albeit while the domestic government in London, and indeed domestic governments across the world, apart from indeed Sweden and arguably Belarus, seem to be closing down the economy once again. In financial centres, the City of London says return to the office is slow going. That's despite the best missives of parishioner Danny Corrigan to keep us updated about what's actually happening in the square mile and which hostleries are open. I find it interesting how many folks are worried about their jobs and yet simultaneously the correlation with people going into the office is low. Let's face it, I mean, if keeping up with the Kardashians is ending in 2021, I mean, if the Kardashian clan can lose a stipend like that, believe me, lots of folks in finance, despite Kardashian-sized egos, are in for a shock, particularly if they don't get to the office soon, methinks. For those who like a wager, the betting market eagerly notes the money was on Biden, but now it's going back on Trump. While the Socioeconomics Institute in the USA notes 87.5% of presidents have been returned to the White House when the Dow has had a net gain of more than 20% over the 3-year period leading to Election Day. That worked, of course, for the previous incumbent of the White House, Barack Obama, when he was himself re-elected to a second term. Will it work for the President of the United States of the moment, Donald J. Trump? If that doesn't trigger you, there's always the prospect of President Trump being nominated for the Nobel Peace Prize, which has been happening increasingly frequently in recent days on the back of his, well, frankly, amazing achievements, bringing diplomatic relations between Israel, first with the UAE and laterally with Bahrain. In mergers and acquisitions, it's bloodbath at Tiffany's, of the litigation variety after LVMH finally pulled out of a takeover they had signed up to before COVID. Then they vacillated and finally ticked the now standard blame Trump box, which appears to be in every blame storm form worldwide. However, the excitement may be in the financial markets, and we'll get to that in a few minutes. LSEG, the London Stock Exchange Group's precipitate sale of Borsa Italiana so they can bulk up on the rather dubious asset of Refinitive's data mining, is drawing heavy bidding from Switzerland, Deutsche Börse and Euronext. What an interesting trifecta. Who's going to be the winner there for Borsa Italiana at the end of the day? And will there be political shenanigans? That said, the big M&A news of today is the possible merger discussions between UBS and Credit Suisse to create a mega banking Swiss powerhouse. That brings us very neatly, ladies and gentlemen, to an interesting, well, first of all, circumlocution, confusion. An interesting day, because here I am in my shirt, and indeed I'm somewhat cold because it's a very stormy day in Valletta, Malta, whereas in London in the UK they're enjoying an Indian summer. Perhaps the weather has improved even because of Brexit, or indeed despite Brexit has been quite the common vernacular in the course of recent years. Jake Pugh is an old friend of mine. He's back in markets after a hiatus in the EU's hub. However, he returns from Brussels without love, because he was there as an MEP for the Brexit Party, where he served from July 2019 until the UK left the EU on January the 31st this year. Having said that, Jake has comprehensive knowledge of capital markets, truly comprehensive knowledge. He's been a fund manager. He's been on the floor of the Life Exchange. In fact, he was there on day one of the Life Exchange in London, if I recall correctly. He's an expert in market infrastructure, and he's worked across multiple kinds of markets, asset classes, and end-to-end business models through a variety of advisory roles, as well as those bits and pieces of his career where he was fully employed for a living in between his advisory work. He specializes in new business initiatives, business design, the development of target operating models, and market engagement. Most importantly, he's an extremely interesting bloke. Jake, welcome. You are live on IPO-VID. Welcome to the show.
Thank you, Patrick. God, did I write that introduction? That was terrible, wasn't it? It was very well. I should have left it to you to write it, my friend. Yeah, just one correction. No, I wasn't down there on day one. I had started at Phillips & Drew with a very nice job in stockbroking, which mummy and daddy thought was entirely appropriate. And then 9 months later, I went down the floor and realized that was the only place to be. So I got down there about 9 months after day one. But yeah, absolutely.
Still pretty early in the piece then. So that was what, late 1983 or early 1984?
Yeah, mid 83, joined Drexel, which was just a fantastic business at the time. Just so well, it actually had under the Doc Sandor had a truly global franchise. So Drexel ran franchise businesses which were typically regional, but the Doc had a global franchise. So the Drexel Burnham IFF, Institutional Financial Futures franchise, was truly global. It was fantastic. Our head of research was Norman Maines, who worked for Volcker at the Fed. So yeah, they were great times and learned a lot.
And of course, that was an epic boss, because I mean, Professor Dr. Richard Sander, well, I mean, he effectively invented the game of financial futures.
Absolutely, and well, I mean, how things have changed. He actually encouraged us to trade. Imagine that now, because he said, obviously trading small, but that's how you'll learn what really moves markets and vol plays or whatever it happens to be. So, of course, people, the market's now so different, but you'd never get that opportunity now. But he was, he was an amazing guy, so charismatic, and obviously we had great fun. And we also, I suppose, we first met Patrick through the good offices of Tullet in Tokyo. And
indeed,
if we're talking about old times, we must bear a thought for Mickey Stiller, who did so much, for the exchange, and so many people, not just at Tullet's, which had an amazing team at the time with Clive and David Kite and Blades and Bam Bam, etc. But Mickey did so much for not only for kind of the exchange, but also for the people within it. He was a very generous, kind man, and so we should remember him.
We definitely must remember him. And in fact, I owe my career in finance to him offering me a job originally on, of all days, October the 19th, 1987, when he was apologizing because there were a few things happening and he was a bit busy at the time in between interviewing me for 15 minutes at the end of my other interview. But yeah, he was a great man, like Stiller. And amongst many people who did so much for the marketplace, who came from extraordinary backgrounds that actually not the sort of backgrounds that you find too many people arriving into finance these days.
Well, that was the most amazing thing about the floor, was that because you had all the different types of firms thrown together, be that stockbrokers, jobbers, commodity firms, investment banks, government broker, every different type of firm. So that meant there were very different types of characters reflecting the nature of their businesses. So we mustn't reminisce too much, apart from giving away our ages. but it was, because the market. But actually, having said that, there's nothing new in the markets. Obviously, you've been a pioneer in terms of the digitalization or the application of technology, but actually all it did is just embed business models. So what do I mean by that? So co-location and high frequency trading in the modern day is just the same as which position where you stood in the pit. Because if you were standing next to the paper filler for whoever it happened to be, Salomon, you effectively had co-location because you had the shortest wire to hit the bid or lift the offer. So whilst technologies changed the business fundamentally, all the fundamentals that underpin the business are kind of are similar.
Well, I think the great example was also Gary Katz, who founded the ISE, the International Securities Exchange, all those years ago. I mean, the one example he used was, note the fact that in the early pictures of Wall Street, the offices of JP Morgan have the largest entrance door, and it's not actually pointing at the New York Stock Exchange. It points slightly at an angle. But when you look at it, you realize that that was actually to allow the blokes to go out of the telegraph room in JP Morgan's and straight in the floor traders' entrance.
Yeah. Yeah.
So co-location has been around. Well, co-location's been around since the 19th century. I mean, carrier pigeons when the Rothschilds sent back ultra low latency data to manage to implement sources. Yeah.
The flow of information gives you that competitive advantage, and effectively you presents an opportunity for arbitrage.
Really. But of course, on the other hand, I mean, one thing we've lived through at all times has been disease. But it has to be said, it feels a bit to me like the reaction to the current pandemic has been rather strange compared to history.
Yeah, it's well, I suppose I think there's a few things to say about the pandemic. The first thing, of course, is to reflect on the the human tragedy. But I see it in many ways when you get radical, substantial. This is going to accelerate change in so many aspects, be that societal, economic, political. I mean, we're going to try not do too much in politics this evening, but I see it actually in many ways as positive. Putting aside, always acknowledging the human tragedy. Beneficial changes, environment, changes to supply chains, which I think the ending of some of the more exploitative global supply chains. I think there's going to be changes, obviously, in terms of city centres. Revitalization of suburbs, working from home, digitalization. I actually see a lot of the changes as beneficial. More reshoring. There's a lot of noise at the moment about you. I mean, you said in your comments about going back to work. I went into the city for the first time for months a couple of weeks ago and had a lunch with a few of us, and it was very interesting listening to actually everybody else who worked for a big firm. And I see quite a big sort of difference between, say, smaller firms, let's say up to 100, and bigger firms, because I think smaller firms are less less set up to work remotely. When you've got a small group, actually, the dynamic is amongst that group. So I think they're sort of keener to get back to work. Whereas for big firms, they can work very effectively because roles are much more siloed. And the large companies are able to work pretty effectively at home. I think the other thing for big firms is there's a big concern about litigation risk, which it hadn't occurred to me until a couple of people at lunch mentioned it. So I think they're very cautious about sort of forcing people to come back to work because of that litigation risk. But I think the other feature of working from home or working remotely is I think the business, financial services, because it's such a sophisticated industry, can operate sort of BAU, business as usual, very effectively. But I think everybody finds that the new business development side is going to be is more challenging because you really need to be face to face if you're doing a deal or building relationships if you're trying to set up some new business. So I do think there are, kind of positives. And my last other thing is this idea that the government has anything to do with telling firms whether people should be going back to work or not. Companies are perfectly capable of working that out with their staff. And I see over the next 18 months, say, firms, depending on the size of the firm, will evolve to new working practices, which will depend on your role, your age, your personal circumstances, seasonality. And I think firms will work that out over the next maybe 18 months. But I certainly don't, the new norm, we're not going back to the old normal. I just don't see that at all.
No, it's very interesting altogether. And indeed, to all those of you, some of you I know are watching this from the office, which is actually a new development that wasn't taking place during Series 1 only a few weeks ago. Send us a question, give us some information. We'll happily take comments. If you've got a question for Jake, far away. We're going to be talking about various topics. I mean, COVID is the topic du jour in many ways. And certainly it's interesting when you look at COVID, Jake, because I think it's also changing quite a lot in terms of the generational impact. I mean, that's going to have a massive impact, isn't it?
Yeah, I think that's absolutely right. I mean, it depending on your age, your personal circumstances. I think as you say, the generational impacts are very variable. I mean, I feel particularly sorry for those who, 40-ish with 2 or 3 children under 10 or something. You're really going to have to sort of replan your life. So I think obviously everybody's impacted to a greater or lesser extent, but I think it is quite distorted, or it's magnified depending upon, which generation you're in. And I think that leads, that generational impact makes one start to think about some of the financial impacts of COVID. And obviously that plays into macroeconomic side around debt. And, the size of the debt now is really becoming just kind of so extreme. So I think you have to start to think about whether one thinks that the size of the debt is a problem or not. Personally, I think it is, because the response of the central bankers going back 10, 12 years to the financial crisis was, to prop everything up and kick the can. And personally, I think that those actions fundamentally contributed to the financial crisis that we have and that we're going to go through.
Yeah. Jake, I think you're frozen for a second. Oh, there you are.
I've still got you. A bit of, taxing a bit more, spending a bit less. I don't see that as any sort of longer term solution. So I think that I hope, although I suspect they're not, they need to start thinking really radically, because I just don't think you can just carry on pushing the debt down to subsequent generations. And I think that the last point I make on sort of the sort of the fiscal and the monetary side is, I think there's we know, if you look at Japan, the Japanification of markets over the last 20, 25 years, negative interest rates have a massively distortive effect and a pernicious effect, in my opinion, because it punishes the eldest and the youngest. You keep alive zombie companies, and you fundamentally distort the price of risk capital. So just more negative interest rates, kicking the can. I just don't think that is beginning to deal with the problems. And it really concerns me when people say, well, if you look at debt levels post Second World War, I think trying to compare the economy now with 70 years ago, I just think it's a fundamental mistake.
Yeah, well, it's such a different economy in every possible way, and it's so globally interconnected in a way it's never been before. And I would agree with you completely on that one, Jake. I mean, it's quite amazing. We've got an absolutely fantastic question from another life veteran, Alex Wilkinson. Alex, I'm going to come to that in just a moment. We're going to give Jake a chance to have a quick read at it while he prepares for that, because I want to talk about one or two other things first of all before we get in.
Can you put the question back up? Because it was typical Alex. It was a long and torturous.
You have a go at answering it now, Jake, if you want to. I'm quite happy to get stuck in. It's a great question. Alex Wilkinson, another long-standing parishioner in the exchange world and exchange trading derivatives.
Yeah, well, as you'll have seen today, Alex, of course, that the Commission is basically going to extend access clearing equivalence, because, of course, I don't want to be too political, but of course we know that is probably one of the strongest cards the UK has, because the clearing capacity doesn't exist in the EU27, either from a capital perspective or from a product perspective. So the EU has extended that. I think it's another 18 months. The next point, I think the total number of equivalence determinations is in excess of 40. So I personally, big picture, I think there's going to be a deal. I think they'll fudge a deal in some way or another, and part of what's going on at the moment is part of that. But I absolutely don't believe that all equivalence determinations will come down, because I don't think either side politically can be seen to be doing that.
So that's interesting. Sorry to interrupt, because the question, the EU and the UK have targeted completion of the equivalence assessments by the end of June 2020. And financial services expected to be a priority area of negotiation. And it's failed so far. So you're giving us an idea of what the outcome will be. But how do you think, I mean, how does that leave finance? Because you can't very well turn around and say, you know, half of finance can be equivalent and half of finance can't.
Well, the equivalence determinations relate to different areas of markets. So you might say, okay, EU27 entities can have access to UK CCPs, but they can't have access to UK equity venues. So I actually think that, or you can do a different determination on data. So I think there will be, I think there will be a deal, but I think equivalence will be selective, because I think politically, and I completely get the EU position on this, they can't be seen to be giving full access on financial services to the UK. It's a bit like saying the UK saying that the EU will have unchanged access into UK fishing waters. That's just, you know, politically not going to be acceptable. So I think there's going to be a subset of equivalence determinations, but I think a deal will be done. So.
Very interesting that you think that a deal will be done, because certainly at the moment it looks as if we're further away from a deal than ever. But at the same time, of course, that is part and parcel of the European Union's desire to have as many long dinners and make sure that the drinks trolley goes around 400 times before they come to a deal somewhere at 3 o'clock in the morning.
I know we're going to touch on politics a bit at the end, but I wouldn't be, you know, I don't think our domestic politicians or our politicians are exempt from criticism, but we can touch on that a bit.
Well, that's very interesting altogether. Thank you very much, Alex, for the question. Feel free to come back with a follow-up if you'd like to. Ladies and gentlemen, if you've got a question for Jake Pugh, they're happy to talk about macroeconomics, the exchange and market structure parish. We've been talking about COVID already, and we might even delve a little bit into politics, or indeed the structure of politics, given Jake's experience as a member of the European Parliament. So, I mean, to go back to the macroeconomic topics for a minute, I mean, you've touched upon debt levels, and I must say, I've been looking around recently, and it's very difficult to find anything other than small Caribbean islands, or possibly Malta, where they managed to actually have their debt to GDP in control. But of course, Malta being part of the EU, they're ultimately going to be sucked into bailing out everybody else on the entire continent if that happens in the near future, which I suspect it probably will. You've talked about kicking the can down the road, but what actually can manage to stop the can kicking? I mean, I realize that's a semi-political point as well.
Well, hang on. If we're going to talk debt with a nod to previous kind of debt problems, I'm going to put on my Argentina cap. I actually think there's, and I did do a bit of work on this. I actually think there is an argument, certainly for looking at debt cancellation, and I'd be very surprised if, you know, the global treasurers, you know, finance ministers, central bankers aren't looking at that. Clearly, it would require, you know, G20 coordination. It would need to be a global effort. But I could see some route to debt cancellation, the purpose of which would be to normalise the interest rate curve, because the interest rate curve as it is just not solving the problem. So I think you could do some debt cancellation. You could then reissue at, you know, normalised rates. I think there was something I was looking at this morning. I think the latest, was it the 10-year bund went at minus 70 basis points or something? Yeah. And so I mean, actually, it's one I was on econ in econ committee in Brussels, and they justify that, they make a big effort justifying that negative interest rates has been proportional and helped the problem. Well, I just don't see it. If you think that's the policy, go to minus 500 basis points. So I just don't think. I mean, we've seen this has been the policy recipe for the last 10 years since the financial crisis, and unquestionably, it has contributed to the debt problems we've now got. So I think you need to do something really pretty radical. I think debt cancellation, normalization of yield curves, because normalization of yield curves, but that means corporate borrowing has to go up, because the problem is you're keeping zombie companies alive, and then you completely distort the cost of risk capital. I mean, you and I think anybody who's a markets practitioner really believes in free markets, and I really don't think that the markets, we have the economy, and we sort of have a version of sort of crony capitalism. I know it's a bit of a trite expression, but markets are not free, and central banks are having a really distortive effect on it. And I just think we need to do something really radical, because that debt problem is not going to go away, and we're going to have another mother and father of collapses at some point.
Well, certainly it's incredible. I mean, you look at some of the deals that have been going around recently, and I mean, if you take a company with a good balance sheet, okay, so therefore we can't say it's a zombie company, far from it. But I mean, Intercontinental Exchange, it's only 20 years old. It's just borrowed 40-year money less than it was borrowing, I think, 20-year money 5 months ago. Yeah. And, it refunded, did the biggest deal in its history buying Ellie Mae. $11 billion deal, great deal, but at the same time, it could go and actually borrow at a cheaper rate than it was borrowing 3 months ago, thanks to the Federal Reserve buying everything. Yeah,
I think that's absolutely right. And that's the other sort of economic point I would make is, as arising from COVID, obviously you've got the debt issue, but also it's an absolute stock picker's dream, isn't it? I mean, this is the moment. Over the last 20 years, the index firms, the index trackers have, been really dominant, and generation of alpha has been a harder thing. But right now, if you are a stock picker, this is your moment. So I don't know what FTSE's, whatever, 10%, 10, 12% off its pre-COVID high, but you've got stuff that's down, 70% and stuff that's up 100%. So
yeah,
and that actually is the link into, I guess, into the parish, isn't it? Because that is.
Well, actually, I was going to stop there, because actually the link before that is, the exciting thing is that I think at the moment you could buy Apple or you could buy the FTSE 100. They're both worth roughly the same thing. When Apple went through $2 trillion just a couple of weeks ago, which strikes me as slightly absurd, given the fact particularly the FTSE 100 is anything but a barometer of Britain. It's a barometer of actually a lot of international trade, and it just shows how far those companies have been left behind. Actually, I want to stop you on one thing, because you haven't talked yet about the US dollar or currencies, and I'm sure you've got something interesting to say there, Jake. And by the way, ladies and gentlemen, if you've got a question for Jake, come on down, send us a message on somewhere on the page, whether you're watching on Facebook, on LinkedIn, or on YouTube. You should be able to find a way to ask Jake a question in one of the boxes in the corner. He'll be delighted to answer it. But yeah, Jake, currencies.
Yeah, so everybody's become, basically saying it's the end of dollar hegemony. I don't claim to be a particularly good FX trader, but I think that is a proper bear trap. The US economy is not going away as the dominant economy, not for a while. And again, there's political challenges, but it is still fundamentally the engine of world growth. And like you said, I mean, just the creativity of their digital businesses. So I would, definitely not giving investment advice, and certainly not when it comes to the FX market, but I definitely would not be short of the dollar at these kind of levels. And I guess the US election in November is in part a reason for that. But it's part of that wider trend of kind of renationalization, if you like, of economic interests, supply chains, etc. You got FX battles, which we haven't really seen for quite a long time. Not quite competitive devaluations, but there's been quite a lot of attention on. I mean, Trump said it quite a long time ago, actually, that effectively, the German economy, is fundamentally supported or helped by an undervalued euro, which really serves the German economy well. So, I think there's, I definitely wouldn't be short of the dollar.
I'm very inclined to agree with that, because actually the one thing that I think has marked our career is when we started our careers, we were just at about the point where everybody had written the dollar off and it was all over. And I mean, in the mid-1970s, it was written off. And it's a bit like the Ferrari Formula One team. Every time everybody writes it off, and after last week's appearance in Mugello, they should be written off. But suddenly within another year or two, it all bounces back and it seems cushy. And the thing I find difficult to believe about the dollar is it just settles so much. I mean, it's that question of, cocoa sitting in warehouses in Rotterdam is all priced in US dollars, as are a gazillion things around the world. And there's absolutely no interest amongst most of the global trading community to move that into euros or Swiss francs or Aussie dollars or Chinese yuan or anything else.
I fundamentally agree. I don't see any of that sort of change away from the dollar being, the currency of international trade. And I certainly don't see that changing, irrespective of the US election result in November.
Yeah, and that is interesting, because of course the issue of Rotterdam-based, dollar-based commodities and things like that, of course, led us into the CCP equivalence debate and all of those other things that have been going on, which I suppose is not quite as elegant as the segue you offered just a moment ago, but gets us to the parish of exchanges. Gosh, it's been such a busy year. It's almost difficult to believe that there have been people in huge numbers of sectors that have been furloughed. And I mean, I don't want to sound contemptuous as I say that, but the exchange business has just been manic.
Yeah, and what really struck me, I suppose, when I finished doing the politics end of January and sort of reacquainting myself in the markets and looking at a lot of the market infrastructure firms, and then what I really saw, which is interesting, is the major divergence in performance sort of post-COVID. So what I started looking at was a pretty sort of simple measure, which is stock performance versus pre-COVID high. Mm-hmm. And I think we've seen greater divergence in stock performance across the sector than we've seen for a very long time. So you had some firms, CME, for example, which was, I think it's still in excess of 20% below its pre-COVID high, and you've got other businesses, let's say like Market Act, and this is across the sort of the Young's pyramid, as it were, from the Div 1 to 2. Obviously, CME in the sort of the Premier League, but then you look at, Market Access, maybe put that in Div 2, Div 3. They were at one point sort of 40% above their pre-COVID high. NASDAQ, strong performer. Euronext, a strong performer. Yep. So CBOE kind of performance being a bit more challenged. And what I saw is that, conditions in NQ1, Q2 were so fantastic for the industry that then creates a problem. Because, of course, what investors expect to see is both top-line growth and operating margin improvement.
Yep.
And that becomes really tricky when you've had such a stellar sort of Q1, Q2. So, you've got real winners and losers, I think. I mean, you talk about Young's Pyramid. I talk about, so a few of us talk about the market cap gap between CME and ICE. I think that got out to about 23 billion at one point. CME over, obviously, shortly after the next deal. It's now into 3.5 billion. Yep. So that is, really massive divergence in performance. And that is going to lead, I think, directly into M&A, because I think that investors, apart from the M&A that we've got that you mentioned at the top of the show about LSEG and potential bidders, and we'll talk a little bit about that. But I see there's going to be more M&A in the sector, because obviously markets have been very becalmed in the last couple of months.
Absolutely, but the M&A is going to be quite interesting, though, because the one thing that we've had in recent times is obviously the collision with antitrust that's taken place. And I mean, Deutsche Börse and London Stock Exchange Group seem to have had a remarkable ability to find antitrust in almost anything that they wanted to do most of the time. What can really be done that manages to get round that antitrust?
Well, and if we're talking Paris, and I should take off my Argentina cap, and in deference to Chicago, I'm going to pop on my Chicago Bulls 3P cap, which those
Excellent.
who follow basketball will know this is a very historic cap from the Chicago Bulls, 3-time NBA. So yeah, I think that antitrust, as we know, is, and I don't see any issue with this, it is truly sort of economic competition that's analysed at one level, but I think again, because of nationalisation of economic interests, I see politics as being a big driver for antitrust.
Yeah.
And I think the idea that CME able to internalise the entire US Treasury, cash and derivatives markets and data or whatever, as long as the US Treasury is okay with that, then they were able to do that. So I think the challenges are political as much as they're economic, and that's potentially what we're going to see with LSE Group and prospective bidders for Borsa Italiana and MTS, aren't we? Because you've got the history of the previous determinations, but fundamentally it is about, I think, the ownership of EU 27 assets. And I completely understand that Vestager and the Commission and the EU would really care about the ownership of those assets. But it is interesting, isn't it, with the number of bidders and if you like, the different profile of the bidders. But I mean, I know you have strong views on the LSE G Refinitiv deal, but where would you? I mean, I still think that I think Borsa will be sold, and I think LSE Refinitiv will close. Do you see the same thing?
Well, I think it will happen, unfortunately, because I still think LSEG Refinitiv is just the worst deal, because LSEG has no coherent history of integrating its deals, and that's my problem. And therefore, trying to integrate Refinitiv, which has always been dysfunctional through the times of being Reuters and then Thomson Reuters, is just not going to be an easy deal. And that's why I think you're going to find the market cap of LSEG. I wouldn't be surprised, as I said last year, I wouldn't be surprised that in 3 years' time we come back and it's worth exactly the same, even though it's added the Refinitiv assets, because it's just going to be so difficult to manage. And that was one of the reasons I thought was a shame, because actually I thought Borsa Italiana did work rather well within the LSEG group. I mean, I suppose maybe that's because it was a Clara first acquisition and had more time to bed down, but it certainly seemed to have been more coherently within the business. But I'm very intrigued by the Borsa Italiana bid situation at the moment, as I think you are. Well, first of all, of course, the price, because everybody said, I mean, last week we were kind of at, maybe, 2 months ago, everybody was about 2.5, 3. Then suddenly it was like 3, 3.5. And I mean, that's going to be your lot. Now we've had the first round of bids. And as far as we understand it, we're 3.5 to 4 billion euros. So we're already at 4.25, 4.75 billion US dollars. So we're way in excess of the sort of numbers that people were expecting that the group could sell for. And if if the rumors are true, if the Swiss are the biggest bidder, then that makes it very interesting, because many people say that Borsa Italiana's Italian Euronext connection seem to be the preferred bidder. They've got a bit of ground to make up. Yeah,
I think that's right. And of course, I mean, one has to say that the Euronext, since its IPO spin out from NYSE, ICE NYSE, has been a major success, because they have really effectively, and I think better than probably a lot of people thought they would do, but it starts to be a stretch, isn't it? Because the market cap of Euronext, what's about €7. So, when you're digesting something, as you say, which is north of 50% of your market cap, it starts to get stretchy, doesn't it? And also the ownership structure of 6 kind of makes it harder for Euronext to know what they're bidding against. And obviously, Deutsche Börse is a very large organisation. So I think structurally, as you've said, Patrick, structurally, Euronext Borsa fits, because you could create something similar to what Euronext did with the IPO, which is sort of a group of reference shareholders to sort of, protect domestic interests, which is completely fine. So I think structurally that looks fine, but ultimately, the shareholders need to be able to approve it, and the business needs to digest it. It was interesting yesterday in the press release that Euronext put out, saying that effectively that Italy would be the highest revenue producing member of the Euronext family, which I thought was quite a kind of nice thing, quite a clever move.
Yeah, and it's very interesting because it's becoming a very, very complex situation. As you say, it's actually changing the whole dynamic. And we've got a great question from Alex Wilkinson I'm going to come back to in just a second. Thank you very much, Alex. But it is interesting because they're changing the dynamic, and certainly both SIX and Deutsche Börse clearly can manage to extend. And what's Deutsche Börse? 28 billion euro market cap as of today. I mean, they can afford to pay more or less any amount of money whatsoever. And that brings us to, I'm so sorry, I'm saying Alex Wilkinson. I'm getting my Alexes mixed up. Alex Maturi, welcome, good evening. Of course, Alex was a magnificent guest during Series 1. Lovely to see you again, former head of S&P Dow Jones Global Indexes. So what Alex is asking is, will the Italians actually allow the Swiss to be the buyers? Because, of course, the Swiss are not in the EU27. It seems as if it might not fit the political narrative, notes Alex. Great question. Thank you very much. An evening of great Alexes.
Yeah, I think that's a very interesting point. I'd also add to, I think it's absolutely right, Alex. I'd also add to it that it's sort of made more sensitive given the SIX acquisition of BME, because you've then got Spanish and Italian assets inside the EU27. It's not like the CCPs are fundamentally clearing very different product sets. So I would imagine you'd want to see some sort of integration of the CCPs. Is that something that both Spain and Italy would go for? So I agree with you. I don't think it does fit the political narrative, but it's not easy to bid against the Swiss, is it? Because you don't really know what you're bidding against in terms of its, as a non-listed, as a private company, you don't know what you're bidding against in terms of their balance sheets and all that kind of stuff. So it is much, much harder. And I guess you could also present a narrative which is the Swiss wanting to deal with the issues they have with the EU in terms of access. We had a really good presentation by a Swiss delegation actually when I was in Brussels, talking about the nature of their sort of complex bilateral deals. And actually the Swiss were saying, in a sense, they would like actually to sort of simplify that. So I think at one level, it complicates the political narrative, but it may provide an opportunity, if the Swiss present it cleverly, for the Swiss and the EU to resolve some of the impasse they have about respective market access.
Very interesting, Jake, the possibility that the Swiss might be able to sell it as a better deal for themselves. I can't help but feel today that things might have got a little bit more complex if there actually is some sort of a UBS Credit Suisse deal in the offing behind the scenes. But at the same time, you're right. I mean, the ability to raise capital, even from the other, whatever it is, 45 bank shareholders of Swiss exchange, is not exactly difficult for SIX if they want a huge amount of money. And I suppose, while we're talking about, huge amounts of money, you mentioned Young's pyramids and the whole issue of the winners and losers and performance divergence amongst the exchanges. We've got this amazing phenomenon at the moment. Retail traders suddenly, having been damned, disowned. I mean, essentially, they were the untouchables of financial investment, and suddenly they've become very much the flavor du jour.
Well, I think there's something really interesting going on in retail. So in a previous life, you can say this about any firm. I did quite a lot of work. I think 97 to 03, I worked all over the Barclays Group as was. And if you think, what I've seen is two things really. One is the US share trading phenomenon in the sort of rally particularly the electronic platforms, kind of Robinhood. And there's this big question about to what extent Robinhood, the retail community, contributed to the rally. So it's a much more complex, so it's a complex and nuanced answer because the impact varies hugely across different, sectors and stocks. But I think everybody agrees that the retail participation, the retail punter, contributed more to the rally than retail punters have done before. And the second thing I think you're seeing is quite a few exchanges, and these are not speculative product launches, but established exchanges introducing more mini contracts.
Yeah.
So I may be putting 2 and 2 together and making some number other than 4, but I sense that the retail participation, probably for the first time ever, is sort of exchanges are acknowledging that. And then the reason I mentioned the Barclays thing is like, any exchange doing a piece of product development, you go and speak to Barclays Capital, you would have gone to speak to BGI, but you wouldn't have gone to speak to Barclays stockbrokers or anything like that. Yeah. So, exchanges would not really be reaching down into that food chain. And I think that's something that is definitely going on. And I think that is a development. And I also think actually, coming back to, we were talking about, you mentioned about Refinitiv deal, is I kind of sense that maybe the data story for the exchanges might just be topping out a little bit. Mm-hmm. So there's now so many, you've got all the exchanges, you've got the pure play data firms like, FactSet Market or whatever. There's now such a proliferation of data. And I get that obviously with digitalization technology, you can analyze the data more, you can put more analytics on it. But I suspect that, that data story, which has really driven the exchanges, I think that might just be topping out. And there's just one reference point on that quickly I'd make is that it's interesting to me, I'll just make a quick comment and not expand on it, is it's interesting to me that ICE have changed their segmental reporting and now put the data business back in the exchange business. So, they were first to go down, really, go down that data route, report it, stand it out. And they're the first, kind of to change that. Plus, of course, they were looking at eBay, which plays into the retail. So I think there's quite a lot of, having had that stellar Q1, Q2, I think there's some challenges for market infrastructure firms coming up.
It strikes me that also I think there's a huge generational play just going on here, which is the whole digital world has managed to develop an amazing amount of knowledge transfer. And if you think about it, it takes 20 to 40 years for most philosophies to kind of trickle down. And, Richard Sander, who we've been talking about, well, he first invented financial futures in the early 1970s. He also, in fact, invented a prototype electronic exchange in 1971 using technology that would be blown away today by even the worst mobile phone. And at the same time, I think, it's taken 20, 40 years. There have been, let's face it, 650,000 people a year doing courses for the National Stock Exchange of India, doing, Futures 101. That's been replicated around the world. Suddenly you start to have a huge number of people, even they've done MBAs or something like that, a huge number of them have got an idea about options pricing. And the facility of all these brokers being available simply changes the game. And that's where I do think a lot of the industry's idea that, they're all going to blow up, lose their money and disappear. I subtly think that this time it's different.
I completely agree. And I think there's an expression people have been talking about, sort of the democratization of finance. And that I think is what you're seeing. I think, clearly it's going to have a different profile because, from an individual's point of view, that's been really driven by, kind of wealth and asset gathering, in the UK, pensions, ISA investments, etc. But what I do see is a merging of those different segments, as if you like, kind of, if you put aside real estate, sort of like pensions, investments, and trading, I think historically they've been quite distinct. Obviously, they've overlapped at the margins, but I see more of that overlap. So I think there are some changes coming down.
I think it's changes, and I think there was a great comment made by Phil McIntosh, the chief economist of NASDAQ, yesterday in a live stream they were doing about the future of retail trading. And what he was noticing was how capital conscious the new era of retail investors actually are, which I think fits back into the mini discussion, and indeed back into the discussion we were having last season with just a month or so ago with Alex Maturi, who asked the question that sort of kicked this segment off, which is quite fascinating. Of course, therefore, we're looking at retail traders, the establishment of, particularly, it has to be said, the buy side seem to regard them as being the deplorables of finance. Well, I think you've probably got another hat up your sleeve, and it's time for the deplorables of politics to have a quick discussion in the last 8 or 9 minutes as we're getting here, Jake. And
no, I'm only doing this because somebody asked me to. I'm not doing it to wind anyone.
Doing it for a friend, yes. Okay.
I did it for a bet, so anyway, sorry. Apologies to all those who find it.
Well, there you go. I'm glad somehow or other you've managed
to all those who find it.
Profit from the show. Yes, well done.
It's meant as a joke. I'm sure not.
Excellent altogether. How did you come by this particular artifact?
Oh, I've got more stash, as my children like. I can put on my scarf, my boxers. I've got all sorts of stuff next door. So amazed we couldn't get rid of it all. I've even got a coaster actually. If you want to.
Oh well, there you go.
Coaster. We've got almost everything.
the things that happen, how economies can be bolstered by electoral politics. So yes, I mean, talk us through a little bit of, particularly given the fact you've seen the inside of Brussels. I mean, the UK as a member state, and go from there. Yeah,
I mean, I lots of people who know me probably don't think I'm particularly balanced in my political outlook, but I do try to be. So I will say this, that I think that the UK was a pretty incompetent member state. So what do I mean by that? So with very quickly I became aware that nobody thought, irrespective of what I might have wanted or people with my same political outlook to myself, that nobody ever thought we were leaving the EU. So I just felt that we'd been really bad at being a member. So what do I mean by that? So we did quite a lot of work on the European Investment Bank, the world's biggest multilateral lender. The UK has 16% of the share capital, but only ever got like 8% of the loan book. And it's a bit like sort of being a member of a sports club that has multi-sports, a dozen sports, and you say, well, I'm not going to use the tennis courts, I'm not going to use the swimming pool. And I felt that if I'd been an advisor, I would have said to the politicians, look, I get and this is not just the UK, it's right across all the member states. They're always, naturally, the domestic politicians are playing to the domestic audience, be that Eurosceptic or whatever it happens to be. And I just thought, right, okay, I would have said to them, right, play to the domestic audience by all means, but if you're in the club and you don't expect to be leaving, then be a much more effective member. So I felt that the UK had been a pretty sort of ineffectual member, actually. So that's no blame on the other member states.
But it has to be said that that's a scintillating opinion to offer while genuinely wearing a Brexit party hat.
Well, I'd say I'm not going to go down the route of the sort of the nature of the institutions, other than to say there's a thing called cordon sanitaire, which sets out institutionally to make sure that there are no Eurosceptics on any of the committee slots. Those are all normally handed out broadly proportional to the size of the grouping in the European Parliament, and I saw firsthand in a number of committees where they elect the officers of the committee, who have basically about 20 committees, 5 committee chairs and vice chairs. So any Eurosceptic was systematically excluded from having a voice on the committee. And I'd also say these people, when I say Eurosceptics, very few people in the European Parliament want to leave the European Union. So that kind of stuff I think is really dangerous, because you're actually deliberately silencing a minority voice, 10, 12% of the European Parliament who don't want to leave the European Union, But to say we're systematically going to remove your voice from the sort of the democratic institution, I think is a really dangerous. And they call it the cordon sanitaire. So they erect this, sanitary cordon around the committee slots, and there's just no sense to it. It doesn't actually, the Eurosceptic voice is a very small one. So that kind of stuff, I think, actually is quite disturbing, really. And that's when we would say it's anti-democratic. That's an example of it. But I don't want to come up here and be too.
No, but so looking at that, though, I mean, on a more national basis, it's quite interesting because you've touched upon the lack of technical expertise that you're seeing in a large number of areas. And I think, you and I have had this discussion offline before. It's actually quite terrifying. And I don't mean this against particularly the European Parliament per se, just going to parliaments and finding the sheer lack of understanding.
Totally, Patrick. And that is, people say to me, what's the biggest difference? And for everybody that we know in the markets, across the whole industry, whether it's your head of operations who knows how every physically delivered commodity gets delivered, whether you're technology in terms of algo or connectivity, whether you're risk, the head of compliance, we're all used to dealing with people with deep technical skills. And that's the thing I found most shocking about politics, is there are very few people with technical skills. They might be adept at dealing with tricky questions on kind of Newsnight or whatever it happens to be, but the whole system of government, you do a few years in the backbenches, then you become a junior minister in transport for a couple of years, then just as you're getting your arms around the brief, you'll then move to be number 3 at defence, then you go to be number 2 at the health service. So I really think the whole structure of government, I'm talking about the UK, not about the EU.
Yes.
Really fundamental, the operation of the state, and coming back to COVID, really fundamentally needs to be overhauled. And my only political prediction would be that if you go back to the 23rd of June 2016, if you like, as the start of disruption, I think populism goes back like about 40 years to Thatcher. But my only prediction is that we are still much closer to the beginning of the political disruption than we are to the end.
Well, Jake Pugh, on that rather exciting, chilling note, I'm going to unfortunately have to draw things to a conclusion, because we have been through an hour of incredible conversation, from business as usual, the impacts of COVID, and many multi-dimensional factors that are going to affect the workplace going forward. Jake has brought us today, 3 different hats, and I have to say, thousands of interesting opinions during the course of the last hour. Thank you to Alex Maturi, thank you to Alex Wilkinson for your excellent questions during the course of the last hour's discussion. We've touched upon a number of areas in the world of politics. We've been looking at macroeconomics, and certainly, I think, amongst other things, the heated agreement that we have on the fact that it's certainly a long way off calling for the fat lady singing over the US dollar's future. At the same time, what's been going on in the world of exchanges, so much happening there and so much excitement. And let me just say, ladies and gentlemen, at this point, if you're looking for the analysis of the news flow on a daily basis, don't forget Exchange Invest Daily, which is my newsletter, the unique news service of the Bourse business. It's read by, illustrious people like Jake, and indeed many of our previous guests, and also the senior management of major exchanges throughout the world. Taking a step back, we've looked at the political issues for today. There's certainly going to be upheaval ahead. And if nothing else, I think the one thing we can agree on is Q4 is just around the corner, and it looks as if it could be a crackingly exciting time. Hopefully during that, we'll have an opportunity to get back together with Jake Pugh and have a further discussion about how the world has been developing. It only remains for me to say thank you very much to Ola and Bata, our production team, for this, the IPO video live stream. My name is Patrick L. Young. We will be back next Tuesday at the same time on the same streams. Thank you for watching. Thank you, Jake Pugh, for being our guest. Have a great week in life and markets, ladies and gentlemen.